When you deposit money in the bank, it doesn't just sit idly in a vault with your name on it, gathering dust. The reality is far more dynamic and interconnected. Think of your deposit as a seed planted in fertile ground, ready to sprout and contribute to something larger. Instead, your money joins a big pool, a collective reservoir, with everyone else's deposits. It becomes part of a larger financial ecosystem, a shared resource that fuels economic activity. This pool represents the combined savings and investments of countless individuals and businesses. The bank, acting as an intermediary, uses this pool to make loans to people and businesses in your community. These loans are the lifeblood of local economies, providing the capital needed for growth and innovation. They empower individuals to achieve their dreams and businesses to expand their operations. For example, your neighbor might get a car loan, enabling them to commute to work or transport their family. This seemingly simple transaction has ripple effects, supporting the automotive industry and related businesses. Or a local bakery might borrow to buy a new, state-of-the-art oven, allowing them to increase production, offer new products, and hire more staff. This investment not only benefits the bakery, but also provides jobs and delicious treats for the community. The bank charges interest on these loans, a small percentage that compensates them for the risk and effort involved in managing the lending process. This interest is how the bank makes money, and a portion of it is shared with you, which is why you earn a little interest on your savings. It's a win-win situation, where both the bank and the depositor benefit from the lending process. This lending keeps the economy moving like a well-oiled machine, facilitating transactions and stimulating growth. Money circulates, creating opportunities and fostering prosperity. It's a catalyst, helping people buy homes, fulfilling their dreams of homeownership, start businesses, creating innovative products and services, and create jobs, providing livelihoods for families and strengthening the community. The bank acts like a heart, pumping money through the community, ensuring that resources are distributed efficiently and effectively. It's a vital organ in the local economic body. Your deposit, even if small, becomes part of this important flow, contributing to the overall health and vitality of the local economy. Every dollar counts and plays a role in the larger picture. Most people don't need all their money at once, so the system works smoothly, with deposits and withdrawals balancing each other out. This allows the bank to confidently lend out a portion of the deposits, knowing that funds will be available when needed. You might withdraw some for groceries, covering your daily needs and supporting local businesses, while someone else deposits their paycheck, replenishing the pool of funds and ensuring the cycle continues. The money flows in and out in a balanced way, creating a stable and sustainable financial ecosystem. So, your money is actually out in the world, actively helping others, supporting their endeavors and contributing to their well-being, but it's still readily available for you when you need it, providing peace of mind and financial security. The bank's job is to manage this lending carefully, ensuring that funds are allocated responsibly and effectively. This involves making sure loans go to people likely to pay them back, minimizing risk, and protecting the interests of depositors. That's how your simple deposit, seemingly insignificant on its own, helps power the entire economy, driving growth, creating opportunities, and fostering prosperity for all. We place our hard-earned money in banks, trusting that it will be there when we need it. But what if everyone, all at once, decides they need their money back? What happens when everyone heads to the bank at the same time demanding their savings? Imagine a rumor spreads like wildfire, a whisper turning into a shout. The rumor? That the bank is in trouble, facing some kind of financial difficulty. Worried about your savings, you and everyone else who banks there start to panic. Driven by fear, you rush to withdraw your savings before it's too late. The first few people in line manage to get their cash, relieved to have their money in hand. But very soon, the bank's vault starts to empty at an alarming rate, dwindling with each withdrawal. Why is this happening? Why can't the bank simply give everyone their money back? Because most of the money isn't sitting idle. It's out on loan, actively circulating in the economy. It's loaned to your neighbor, perhaps to help them buy a home, or to the bakery down the street, helping them expand their business, and to countless other businesses and individuals throughout the community, fueling growth and opportunity. The bank only keeps a relatively small amount of cash on hand in its vault. This cash reserve is designed to handle normal, day-to-day withdrawals. But when too many people, gripped by fear, demand their money all at once, exceeding the bank's reserves, the bank simply runs out of readily available cash to meet the overwhelming demand. The teller is forced to deliver the bad news, having to say, "Sorry, we don't have any more cash available right now. We're temporarily unable to fulfill withdrawals." Panic spreads like a disease through the crowd, amplifying the initial fear, and the situation quickly spirals out of control, escalating into chaos and uncertainty. The core problem isn't that the money has vanished into thin air. It's simply not immediately available in the form of physical cash. The entire financial system relies on a foundation of trust, the collective belief that not everyone will simultaneously demand all of their money back at the same time. When that trust is broken, when widespread fear takes hold, the bank and potentially the entire financial system can't function effectively. This is precisely why maintaining confidence in banks and the financial system is so critically important for economic stability. The money is actively circulating out in the community, being put to work to generate economic activity, not simply sitting idly in a vault, gathering dust. The entire system only works effectively when people maintain a strong belief that their money is safe, secure, and readily accessible when they need it. Imagine a scenario where unease begins to ripple through a community, a sense of financial insecurity taking hold. This escalating anxiety can manifest in a very specific and potentially devastating event. This panic is called a bank run. A bank run happens when lots of people, driven by a shared fear or concern, simultaneously try to withdraw their money at once from a particular bank or financial institution. The lines grow longer, the atmosphere becomes more frantic, and the pressure mounts. This mass withdrawal is fueled by a growing belief, whether justified or not, that the bank will fail. Ironically, it's the fear itself, the collective loss of confidence, that often becomes a self-fulfilling prophecy and causes the problem. Even a healthy bank, one with sound financial practices and sufficient assets, can collapse under the immense strain if enough people panic and demand their money back all at the same time. It's like musical chairs. As long as everyone moves calmly and rationally, understanding that resources are finite, there are enough chairs to accommodate everyone. But if everyone rushes at once, driven by individual self-preservation, some are inevitably left standing, without a seat. In a bank run, the chairs are the readily available cash the bank has on hand to meet withdrawal demands. Historically, before modern banking regulations and safeguards, bank runs were a relatively common occurrence and often had devastating consequences for individuals and the economy as a whole. During the Great Depression, a period of immense economic hardship, countless people lost their life savings overnight as banks succumbed to the pressure of mass withdrawals and ultimately failed. The real danger in a bank run isn't simply the potential loss of money itself, but the erosion and ultimate loss of trust in the financial system. Trust is the invisible glue that holds the entire banking system together, enabling it to function smoothly and efficiently. When that trust breaks down, whether due to genuine financial instability or simply widespread panic, the entire system can fall apart with alarming speed. Even a false rumor, a baseless piece of misinformation, can be enough to trigger a real crisis of confidence and spark a bank run. That's why maintaining public confidence in the stability and security of the banking system is absolutely crucial for economic stability. The entire banking system depends on everyone believing, with good reason, that their money is safe and accessible when they need it. Without that fundamental trust, even the seemingly strongest and most well-established bank can ultimately fall victim to a self-inflicted crisis. So why doesn't the bank keep all your cash in the vault? If banks just stored your money, they'd be expensive lockers, not engines of the economy. Modern banking uses a system called fractional reserve banking. Banks keep only a fraction of deposits as cash, maybe 10%, and lend out the rest. Your $1,000 deposit might mean $100 stays in the vault, while $900 is loaned out. This process helps create more money in the economy and supports growth. If every dollar just sat in a vault, there'd be far fewer loans and much less economic activity. The system works because not everyone withdraws their money at once. On a normal day, deposits and withdrawals balance out. The small cash reserve is enough for daily needs. The risk comes only if there's a sudden widespread panic. That's the trade-off for a dynamic, growing economy. When one bank faces a run, fear spreads quickly. People at other banks get nervous and rush to withdraw their money too. This domino effect is called contagion. As more banks face runs, they stop lending and scramble for cash. They might demand businesses repay loans immediately, but most can't. Businesses may have to lay off workers or sell assets, causing more job losses. The economy slows down as banks stop lending and people lose jobs. With less money coming in, more people withdraw savings, putting even more pressure on banks. Credit dries up, no loans for homes, cars, or businesses. The financial system grinds to a halt. Your bank account becomes a source of anxiety, not security. Payments bounce, cards stop working, and daily life is disrupted. A banking crisis quickly becomes an economic catastrophe. When a banking crisis gets out of control, the government steps in. In the US, the Federal Reserve and the FDIC play key roles. The FDIC insures your deposits up to $250,000, so even if your bank fails, you get your money back. This insurance was created after the Great Depression to prevent panics. Knowing your money is protected keeps people calm. The Federal Reserve can also lend emergency cash to banks running low. This lender of last resort role helps stop the domino effect. In extreme cases, the government might bail out big banks to prevent total collapse. These actions are controversial, but the goal is to protect everyone's savings and keep the economy running. The government can also lower interest rates to encourage borrowing and spending. Ultimately, the government acts as a backstop to restore trust and stability. These tools are designed to keep the financial system from unraveling. Without them, a crisis could spiral out of control. Imagine if all banks shut down. Debit and credit cards would stop working instantly. You couldn't buy groceries or pay bills electronically. Most people don't have enough cash on hand for daily life. Paychecks would stop since companies couldn't transfer money. Businesses couldn't pay suppliers or employees. International trade would freeze, no payments, no shipments. The economy would grind to a halt. People might resort to bartering goods and services. But barter can't support a modern society. Money is the universal medium of exchange, and banks make it move. Without banks, the web of transactions that supports our lives unravels. Daily life would become chaotic and uncertain. The modern world depends on a functioning banking system. A banking collapse would devastate jobs and prices. Businesses rely on loans for daily operations. Without loans, restaurants can't buy food, factories can't buy parts, and construction stops. Mass layoffs would follow across every industry. Unemployment would skyrocket, and people would stop spending. This would cause even more businesses to fail, a downward spiral. Prices for essentials like food and gas would soar as people scramble for limited goods. Meanwhile, prices for things like cars and houses would crash because no one could afford them. Shelves would empty quickly as people hoard necessities. The result: inflation for basics, deflation for everything else. Who has cash and essentials would matter more than ever. The economy would split into haves and have-nots. It's a world no one wants to live in. Thankfully, a total banking collapse is very unlikely today. We've learned from past mistakes and built strong protections. The most important is deposit insurance like the FDIC. Knowing your money is insured removes the main reason to panic. Even if your bank fails, you'll get your money back. Strong regulations require banks to keep enough reserves and limit risky behavior. Regular inspections catch problems before they grow. The central bank acts as a safety net, providing emergency cash if needed. These measures prevent a temporary problem from becoming a crisis. The system relies on smart rules, safety nets, and public trust. By ensuring deposits and regulating banks, we keep the system stable. Trust is the foundation. When it's strong, your money keeps working for you and the economy. That's how we keep the financial system safe for everyone.